Welcome to Capital Allocation Lab.
Please subscribe and tap like so more learners can find these episodes.
Today, we're doing a deep dive, really getting into the weeds on two, let's say, complex instruments that often trip up fundamental investors. We're talking convertible securities and stock warrants.
Right. And our mission here is pretty straightforward. We want to cut through that complexity, really unpack what these hybrid assets are all about.
And translate the core ideas into practical decision rules, stuff you can actually use.
Exactly, because you hear this pitch all the time, don't you? It's the best of both worlds. But, well, the source material we're drawing on is very clear. It's usually a compromise, a carefully calculated one. And we need to see that illusion for what it is right from the get-go.
That makes sense. The core idea, the philosophy here, seems crucial. There's just no free yield in finance.
Nope, never is.
Every time you get some kind of privilege in the capital stack, maybe you get seniority over common or guaranteed coupon, you're giving something up somewhere else. It's a trade-off.
Always a trade-off. For convertibles, the investor usually gives up yield. You accept a lower coupon, maybe a lower dividend, than you get on a plain old bond or preferred stock from the same company.
Okay, so that's the cost for the convertible holder. What about warrants? Who makes the concession there?
With warrants, it's the existing common shareholders. They're the ones giving something up. They essentially give away a piece of their future upside because of the potential dilution those warrants represent.
So future dilution is the price. We really need to be able to measure these compromises, put numbers on them before we can decide if they're actually worth it. Okay, let's start with the basics then. Convertible securities, probably the most common type people run into. What exactly is one?
Okay, so a convertible security is, well, it's a senior claim first and foremost. It could be a bond or maybe a preferred stock. But the key thing, the kicker, is it has an embedded option built right in.
An option?
Yeah, an option. It gives whoever holds the security the right but not the obligation, obviously, to exchange that senior security for a certain number of common shares. And that exchange happens at a price that's set beforehand. The conversion price.
Ah, okay. So it's got this sort of split personality. It gives you that safety of being higher up in the capital structure than common stock.
Right, that buffer.
But its ultimate fate, or at least a big part of its potential return, is tied to how that underlying stock does because of the option.
Precisely. You're kind of hoping for a floor if things go bad.
Yeah.
But you also want to participate if the stock takes off. But like we said, that participation isn't free. You accept that lower fixed yield compared to a regular non-convertible bond or preferred.
Got it. Now, what about warrants? They feel related, maybe cousins, but you said they're structurally different. How so?
Yeah, they are different. Warrants are basically long-dated rights-think options, but usually with much longer terms, years even. They give you the right to buy common stock at a specific price, the exercise price.
Okay, long-term options.
But here's the main distinction from convertibles. Warrants aren't senior claims themselves. They don't pay interest or dividends. They are purely optional claims on future equity.
I see. So no current income, no seniority, just the right to buy stock later, if it makes sense.
Exactly. The trade-off is maybe a bit clearer. For the company issuing them, warrants can be a way to raise capital, sometimes maybe on slightly better terms initially than debt or just issuing straight equity. But for the existing common shareholders, it's a direct giveaway. They're letting go of a slice of future ownership in return for whatever cash the company gets if and when those warrants get exercised down the road.
Sounds like something a company might do if it really needs cash, maybe. But it's definitely a cost to the existing owners that you absolutely have to track. This whole conversation really hinges on being able to measure these things properly.
It does, which means we've got to get comfortable with the basic math. It's not super complicated, but it's essential. Let's start with the conversion ratio, usually just called the CR.
Okay, the CR, what's that?
It's really the foundation for everything else with convertibles. It's simply the fixed number of common shares you get if you decide to convert your bond or your preferred share.
A fixed number.
Right. Let's use an easy example. Say you have a convertible bond with a $1,000 par value, that's the face value. And the company set the conversion price at $25 per share.
Okay, $1,000 par, $25 conversion price.
To get the CR, you just divide the par value by the conversion price.
Yeah.
So $1,000 divided by $25.
That gives you 40 shares?
Exactly. 40 shares, that's your conversion ratio. And assuming there aren't any weird anti-dilution adjustments later, that number 40 stays the same for the whole life of the bond.
Got it. CR equals 40. What's next? Parity. Or conversion value, same thing.
Yeah, same thing. Parity is basically asking, what's this convertible worth right now if I just turn it into stock? It ignores any premium for the bond features for a moment.
Okay, so it's the pure stock value embedded in the convertible.
Precisely. Using our CR of 40 shares, if the underlying common stock is currently trading in the market at, say, $30 a share, then parity is just 40 shares times $30 per share.
Which is $1,200.
$1,200, that's the conversion value. Theoretically, if the stock price is way above the conversion price, the convertible shouldn't trade for less than $1,200 because you could always just convert it and immediately sell the shares for that amount.
Right, makes sense. But you often see convertibles trading for more than their parity value. That difference is the premium, right? The conversion premium.
Exactly. The conversion premium is that extra amount, that markup you pay over the current parity value just to hold the convertible security itself.
And why would you pay extra? What are you getting for that premium?
Well, you're paying for a couple of things. One is the yield you're still getting from the bond's coupon payments. The other is the downside protection, the theoretical safety net provided by the bond floor, which we'll get to.
Okay, so in our example, parity was $1,200. If the convertible bond is actually trading in the market for $1,250.
Then the premium is simply the difference. $1,250 minus $1,200 is $50. That's your dollar premium.
And as a percentage, how do we figure that out?
You just divide the dollar premium by the parity value. So $50 divided by $1,200.
Let's see, 50 divided by 1,200, that's about 0.0417, so roughly 4.17%.
Yep, 4.17%. That percentage is effectively the upfront cost you're paying to keep your options open to delay converting, hold on to your seniority for a bit longer, and collect those coupon payments.
Okay, premium makes sense. Now, you mentioned the bond floor. That sounds critical for risk management. Investment value or bond floor?
It really is critical. The bond floor or investment value is your estimate of what the security would be worth if you completely ignored the equity option, just stripped it away.
So valuing it purely as a bond.
Exactly. Imagine, like the source suggests, a bond analyst who's, say, forbidden from even thinking about stocks. All they care about is the company's credit quality, the coupon rate on the bond, the maturity date, and what current interest rates are for similar bonds. What would they pay for this piece of paper? That value is the bond floor.
That's a great way to think about it. It forces you to anchor the downside case in actual creditworthiness.
It has to be anchored in real credit quality. You know, if the company's financials are shaky, that investment value, that floor, is going to be pretty low, no matter how exciting the stock story seems.
Right.
The source really emphasizes this. The floor needs to be real, not just something you hope for. If you look at comparable straight bonds from the exact same company, and they're trading around, say, $900, well, the $900 is probably a realistic floor for your convertible, give or take.
And if the credit is junk,
Then the floor is junk, too.
yeah.
It's shaky. And if you're relying on a shaky floor, you're really just fooling yourself about the safety. Getting this math and these concepts straight is absolutely key to seeing past that best of both worlds sales pitch.
Okay, we've got the mechanics down, the math, but let's talk about the psychology. Why does that best of both worlds idea so often end up being, well, the worst of both?
Yeah, the pitfall is often behavioral, isn't it?
Right.
That embedded option, the exciting part, it looks most appealing, it gets marketed the hardest, and consequently it gets most expensive, meaning the premium is highest right when the market is near a peak.
Ah, so you pay the most for the option when everyone's feeling euphoric about the stock market.
Exactly. And then what happens? The market corrects, the stock price drops, maybe below the conversion price, and poof, that option value just shrivels up.
And you're left holding.
You're left holding a bond that pays a lower coupon than you could have gotten elsewhere, and it's tied to a stock story that's suddenly looking pretty weak. You focus so much on the potential upside that you kind of ignore the compromise you made on the yield.
And then regret kicks in. Loss aversion, maybe.
Absolutely. You feel like you made two mistakes, right?
Yeah.
You missed the equity gains you hoped for, and you accepted a lower yield on a bond you maybe didn't fully respect on its own merits. So people panic, sell the bond when it's weak, and lock in the loss.
Okay, I see the behavioral trap. But hang on. What if the stock really is a potential home run? A 10-bagger, let's say. Are we maybe being a bit too cautious here, focusing too much on that $900 bond floor? If the equity part can make you 3x your money, does the floor really matter that much? Isn't this focus on credit quality just making us miss the big asymmetric upside?
That's a really good question, and it gets right to the core tension. But I think it misunderstands why you'd buy the convertible in the first place. If your only goal is massive, asymmetric equity upside.
Then you should just buy the common stock.
Right, just buy the stock.
Yeah.
By choosing the convertible, you are making an active choice to trade away some of that potential pure equity upside in return for, well, for the bond features.
Yeah.
For the coupon and that theoretical floor.
Yeah.
If you then ignore the quality of that floor,
You've basically just bought expensive, low-yielding stock.
pretty much, you paid a premium for something that still carries most of the stock's risk, maybe even more if the credit's bad, plus you get less income. So the discipline has to be only buy the convertible if you genuinely want to own the underlying business anyway, with or without the option kicking in.
Okay, that clarifies it. The option is like the bonus feature, not the main reason for buying. So to enforce that discipline, we need a checklist, a mandatory pre-investment checklist. If you're looking at a convertible, you absolutely have to ask these questions. First one.
First, do I actually want to own this business for the long haul? Even if I never convert, forget the option for a second. Is this a company I want to be involved with?
Okay, second question.
Is the conversion premium I'm paying reasonable? Think about the stock's likely volatility, how much it might move, and critically, your own investment time horizon. If you're paying a 15% premium over parity, but you only expect your thesis to play out over the next year or so, that premium might be way too high compared to the small yield advantage you get in that short time.
Makes sense. Third.
Is the credit risk acceptable on its own? This goes back to the investment value, the bond floor. If the company's debt is rated poorly, if it's distressed, that floor isn't going to be solid if the stock disappoints. You have to be comfortable with the credit, period.
Fourth. This one sounds important.
Call protection. Is there strong call protection? Because call risk is the company's right to basically snatch away your option, often right when it's becoming most valuable because the stock has run up. You need protection, ideally several years, where they simply can't call the bond away from you.
Okay, good call protection. And the fifth and final question.
It circles back to the floor again. Is that bond floor robust enough, realistic enough, that if the stock completely tanks, you'd still be genuinely okay owning the bond itself, just clipping the coupon until it matures?
And if you can't answer yes confidently to all five?
Then you pass. The security fails the test. Don't let the equity story override the fundamental weaknesses.
Okay, let's make this even more concrete. Let's go back to our example and walk through the earn back logic. You said that's really key for deciding if the premium is worth paying.
It is. So a quick recap of the setup. We have a 6% convertible bond, a $1,000 par value. The conversion price is $25, which gives us that conversion ratio of 40 shares. The stock is currently trading at $30, making parity $1,200, 40 by $30. And the bond itself is trading in the market at $1,250.
Right. So we established we're paying a $50 premium over parity, which is about 4.17%. First, what are we getting in return for that premium besides the option itself?
Well, we're getting the coupon payment. The bond pays 6% on its $1,000 par value, so that's $60 per year in interest.
Okay, $60 a year.
But remember, we didn't pay $1,000 for the bond. We paid $1,250. So our actual current yield, the yield to price, is $60 divided by $1,250.
$60 divided by $1,250, that's 0.048 or 4.8%.
Exactly, 4.8%. Now let's say a regular non-convertible bond from the same company with similar credit quality and maturity yields 7%. That difference, 7% minus 4.8%, is 2.2 percentage points, or 220 basis points.
Yeah.
That lower yield is essentially the ongoing price you're paying each year for having that conversion option.
Got it. We paid $50 upfront as a premium, and we're getting 2.2% less yield each year. Now, how does the stock price factor into earning back that initial $50 premium?
Right, the earn back. We need the conversion value, the parity, to increase by that $50 premium amount just to break even on the premium itself. Since our conversion ratio is fixed at 40 shares, we need to figure out how much the stock price has to go up to make those 40 shares worth an extra $50.
Okay, so we divide the $50 premium by the 40 shares in the CR.
Yep. $50 divided by 40 shares equals
$1.25 per share.
$1.25. So the underlying stock needs to rise by $1.25 from its current price of $30 up to $31.25 just for the parity value to reach the $1,250 price we paid for the bond.
So $31.25 is the break-even stock price for the premium. Only above that price are we starting to make a profit that's actually driven by the equity component beyond just getting our premium back.
Precisely. And that $1.25 move on a $30 stock, that's a required stock appreciation of about 4.17%. $1.25, $30.
Okay, 4.17%.
Now you have to ask yourself, is it reasonable to expect the stock to move up 4.17%? And crucially, within what time frame? Is it likely to happen in the next year or 2 years? And maybe most importantly, is it likely to happen before the company might be able to call the bond away? If you think the stock's going to be flat for ages, paying that 4.17% premium means you're underwater on the option value for a long time.
It really puts the premium in perspective. Now, let's stress test the downside again, the bond floor. We estimated that if similar straight bonds yield 7%, maybe our convertible's floor is around $900.
Right, based purely on its bond characteristic.
We bought the convertible at $1,250. If the stock thesis completely falls apart, the option becomes worthless, and the price theoretically drops towards that $900 floor. What's the damage?
The potential loss is $1,250 minus $900, which is $350.
And as a percentage of our purchase price, $350 divided by $1,250, that's 28%. Ouch.
Yeah, a 28% hit on something that was supposed to offer some downside protection, that's significant. And it hammers home that rule. If you would be willing to buy the straight bond at $900 today, knowing what you know about the credit,
Then you shouldn't buy the convertible at $1,250 just because you're excited about the stock. The option doesn't magically fix a weak credit.
never does. Pass on it.
Okay, downside clear. What about the happy path? The stock does really well. Let's say it rallies strongly, goes up to $40 a share. What happens then?
Okay, stock at $40.
Mm-hmm.
Our parity calculation is now 40 shares times $40 per share.
That's $1,600. The conversion value is now $1,600.
Right. The bond is now what we call deep in the money. The value comes almost entirely from the stock it converts into. Now, put yourself in the company's shoes. They have this $1,000 bond on their books, legally, but it represents $1,600 worth of their stock.
They'd probably rather have the debt off their books and just issue the shares.
Exactly. They're highly incentivized to call the bond, force conversion, get rid of the debt, and clean up their balance sheet by issuing that new equity.
So they might issue a call notice. Let's say they call the bond at $1,050. Often there's a small premium over par in the call price. Stock's at $40. Parity is $1,600. What's the choice for the bondholder?
The choice is stark. You can either accept the $1,050 cash the company is offering you in the call, or you can convert your bond into 40 shares of stock, which are currently worth $1,600 in the market.
Seems like a no-brainer. You convert and take the shares worth $1,600. Taking the $1,050 call price would be leaving $550 on the table.
It would be a massive mistake. But it happens. This just underscores why you need a plan before this happens. You have to know you're going to convert in this scenario to capture that full value. If you're caught sleeping or you hesitate, the company effectively forces you into a much worse outcome.
Okay, so both failure and success can lead to bad decisions if you're not prepared. Failure makes you want to sell low. Success makes you maybe want to hold on too long, get greedy.
Right. Emotions take over.
So the antidote, according to the source material, is discipline. Specifically, a written 3-scenario playbook, something you create before you even buy the convertible.
Yes, this is such a powerful behavioral guardrail. You map out your plan for the 3 most likely outcomes: bull case, base case, bear case. Let's walk through what that looks like.
Okay, start with the bull case. Everything goes right. The business does well. The stock takes off. Say it's up 50% from our starting point. It goes from $30 to $45.
Okay, stock at $45. With our 40-share CR, parity jumps from $1,200 up to $1,800, 40 by $45. The convertible's price will closely track that $1,800, maybe with a small remaining premium. What's your action plan now?
This is where the pre-commitment comes in.
It is exact. You need predefined points where you take some profits off the table. You might write down, if the convertible hits $1,500, I will sell 25% of my position. If the stock hits $45, I'll sell another 25%, no matter how good things feel. You have to systematically harvest those gains. It locks in profit and prevents the position from becoming too large in your portfolio just because it went up.
Okay, lock in gains in the bull case. What about the base case? The stock doesn't soar, maybe it's flat or just up a little bit, but the business itself is doing okay, chugging along.
In that scenario, well, you're mostly just clipping that coupon. Remember, our yield to price was 4.8%. You're earning that, and maybe over time, the small amount of stock appreciation helps earn back some of that initial premium you paid. Your return basically looks like, well, like a mid-single-digit bond return.
Which is okay
If you respected the credit quality in the first place. If the bond floor was solid, this is an acceptable outcome. You just monitor the credit, keep an eye on that call risk, maybe check interest rates, but otherwise you're patient.
All right, now the tough one, the bear case. The business hits a rough patch, the stock gets whacked, maybe down 30%, 40%, 50%. The conversion option is now way out of the money, effectively worthless.
Now, everything hinges on that bond floor we talked about, the $900 estimate in our example.
Hmm.
If you did your homework up front and concluded you'd be comfortable owning the straight bond at $900.
Then you grit your teeth, except the stock didn't work out, but you still own an income-producing asset you understand and value.
Precisely. The regret is minimized because you planned for this. Bet if you didn't do that homework, if you secretly wouldn't have touched the straight bond at $900, the pain is intense. The rule here is discipline. Only buy if this worst-case scenario leaves you with a bond you still respect, and if the credit quality itself starts to deteriorate in this scenario, you probably need to sell, even near the floor, before it gets worse.
This really highlights the need for that upfront honesty. The source even suggests writing a short memo to yourself.
Yeah, I love that idea. Just a one-page note. Write down why you're buying this convertible, primarily as a bond focus on the credit, the yield, the floor, and then explicitly list the conditions under which you will sell it, no matter how bullish you might feel about the stock later. It's like taking out an insurance policy against your own future emotions.
Okay, so analyzing these hybrids can sometimes uncover other opportunities too. The source mentions something called a switch trade. What's that about?
Yeah, this is interesting. Sometimes when you dig into the details, you find that the senior security, often a convertible preferred stock, is actually a better deal, just a flat-out better bargain, than owning the common stock directly.
So you might switch out of the common and into the convertible preferred.
Exactly. It happens when the convertible preferred is trading at a price that's only slightly higher than the value of the common stock it converts into, but it offers significant advantages, like a much higher dividend and that all-important seniority.
Let's try an example. Say there's a convertible preferred stock, and each preferred share can be exchanged for 1.5 shares of the company's common stock.
Okay, converts into 1.5 common shares.
And let's say the common stock is trading at $50 per share.
All right, so the conversion value, the parity of that preferred share is 1.5 times $50, which is $75. That's what the common stock package is worth.
Now, you look up the price of the actual convertible preferred share in the market. What if it's trading for, say, $76?
Okay, $76 market price versus $75 parity value. That's only a $1 premium, or about 1.3%. That's tiny.
And what if that preferred stock also pays a guaranteed dividend yielding, say, 7% on the $76 price, while the common stock pays maybe only 1% or nothing? And the preferred has seniority in case of trouble.
Well then, switching your money from the common stock into that convertible preferred looks like a fantastic move. It's almost an arbitrage, really.
You're getting much higher income, much better safety due to seniority, and you're giving up almost nothing in terms of the equity potential because the premium is so small.
Exactly. Plus, that preferred share has a sort of double floor. It shouldn't trade much below the $75 value of the common it converts into, as long as the common has value. And below that, it still has its own underlying bond floor based on its credit quality and dividend. It creates this downside anchor you just don't get with the common stock alone.
So the key is comparing apples to apples. The value of the common stock package you get on conversion versus the actual market price of the senior security.
Right. If the premium is minimal and you gain significant yield and seniority, making the switch can be a smart way to upgrade your position in the company's capital structure without sacrificing upside.
All right, let's shift gears completely now and talk about warrants again. The tone in the source material seems much more skeptical, almost hostile towards warrants compared to convertibles.
I think that's fair. There's a definite policy of skepticism advised. Because warrants, especially if there are a lot of them outstanding relative to the common shares, they act like this silent drag on value for the existing shareholders.
How so? A silent drag.
They basically siphon off a part of the company's future success, the future upside, that would have belonged entirely to the common shareholders if the warrants didn't exist. Every time the stock goes up, those warrants become more valuable, representing a claim on future equity that dilutes the existing owners.
And they mess up the per-share calculations too.
Massively. They can make per-share earnings or book value figures look artificially better than the underlying economic reality, because the potential dilution isn't always fully and clearly accounted for in headline numbers.
So the rule for common shareholders has to be, if there's a significant warrant overhang, you must adjust your thinking and your valuation.
Absolutely mandatory. You have to treat those warrants as part of the company's effective capitalization, part of the total claim on the business.
How do we do that? The source mentions a simple adjustment model or the market value approach.
Yeah, the market value approach is usually the simplest and often the most conservative way to do it. Let's run through an example.
Yep.
Say a company has 100 million common shares out. and they're trading at $10 a share.
Okay, 100 million shares at $10. That's a $1 billion market cap for the common equity.
Right. Now, let's say there's also a big chunk of warrants. 20 million warrants are outstanding. And these warrants themselves are trading in the market for $3 each. Let's also say their exercise price is $12, just for context.
Okay, 20 million warrants trading at $3.
With the market value approach, we just calculate the total market value of all those outstanding warrants and add it directly to the market value of the common stock.
So 20 million warrants times $3 market price. That's $60 million worth of warrants.
Yep. Now add that $60 million to the $1 billion market cap of the common stock.
Okay. $1 billion plus $60 million gives $1.06 billion.
That $1.06 billion represents the total effective market claim on the company's equity, considering both the common stock and the warrants. It's the price to buy the whole pie, including the potential dilution.
So how does that affect the price per share for the existing common shareholders?
You take that total pie value, $1.06 billion, and divide it by the original number of common shares, the 100 million shares.
$1.06 billion divided by 100 million shares. That's $10.60 per share.
Exactly. So even though the stock quote might say $10, your effective price, considering the warrant overhang, is really $10.60. You're paying a hidden 6% premium because of that dilution potential represented by the warrant value.
Wow. So ignoring warrants just flat out understates the price you're paying.
Completely.
Mm-hmm.
It makes the stock look cheaper than it really is, economically.
The source also mentions something called the Treasury method as an alternative way to think about dilution. How does that work, just conceptually? Is it better?
Yeah, the Treasury method is another way, often used in official EPS calculations. It's a bit more involved. The basic idea is it assumes the warrants are exercised, so the company receives cash from the exercise price.
Okay, in our example, 20 million warrants exercised at 12. That's $240 million in cash coming into the company.
Right. The Treasury method then assumes the company uses that $240 million in cash to theoretically buy back its own shares in the open market at the current stock price, $10 in our case.
So $240 million divided by $10 per share, they could theoretically buy back 24 million shares?
Correct. Now remember, exercising the warrants created 20 million new shares, but the cash received allowed them to buy back 24 million shares. So the net effect under the Treasury method in this specific example where the stock, $10, is below the exercise price, $12, actually suggests a decrease in shares.
Wait, that seems counterintuitive. Dilution results in fewer shares.
It does seem weird. And that highlights why the Treasury method gets complicated, especially when warrants are out of the money, like in our quick example. It's typically applied when the stock price is above the exercise price, and it calculates the net increase in shares, new shares issued minus shares repurchased. For our purposes, honestly, the market value approach, just adding the market value of the warrants to the equity cap, is usually simpler, more intuitive, and acts as a good conservative check against overpaying.
Okay, stick with the market value approach for a quick sanity check. The main takeaway seems to be about clarity and acknowledging the dilution.
Absolutely. Two key habits. Habit 1. Always run a quick, fully diluted calculation in your head. Imagine everything converts, everything gets exercised. What does the share count look like then? Habit 2. Calculate your own true price per share by adding that warrant market value, like we just did, and be really suspicious of any company that reports per share earnings or metrics without clearly addressing a large warrant overhang. Focus on the total earnings available to all equity holders first.
Okay, let's bring this back to managing risk within a portfolio. We touched on call risk for convertibles earlier, but let's dive deeper. You called it the issuer's primary weapon.
It really is. A convertible bond that has weak call protection, or none at all. It's just fundamentally less attractive for a long-term holder. It's like having a great lease on an apartment, but the landlord can kick you out with short notice whenever they feel like it.
And they'll feel like it when it benefits them the most.
Precisely. Right. Which is usually when the stock has performed really well and your conversion option is deeply in the money and most valuable to you. That's exactly when they'll pull the rug out.
So when we're looking at a convertibles terms, what specifically signals good or bad call protection?
You want to see hard call protection first. That means a number of years, clearly stated maybe 3 years, 5 years, where the issuer simply cannot call the bond for any reason. That's the best.
Okay, hard call protection. What happens after that?
Then you look at the call price. Does it stay above par for a while, maybe stepping down slowly over time? Or does it drop right back to par, $1,000 immediately? A slow step down is better. And then you really have to watch out for soft call provisions.
Soft call, what's that? Sounds sneaky.
It kind of is. A soft call provision allows the company to call the bond before the hard call protection ends. But T, only if the underlying common stock price trades above a certain level, often something like 140% or 150% of the conversion price for a specified period, like 20 out of 30 trading days.
So they're saying we won't call it. Unless it starts making you too much money, then we reserve the right to call it.
That's basically it. These soft call terms really define the true potential lifespan of your option value. If they exist, you have to factor them into your expected holding period.
And this call risk needs to tie directly back to that pre-written playbook, specifically the sell plan part.
Absolutely. If analysis suggests a call is becoming likely, maybe the stock is approaching that soft call trigger price. You need to know in advance what you're going to do. Will you sell the convertible in the market to capture the remaining premium, or will you convert it into common stock?
And the default rule should probably be,
Keep it simple. If you wouldn't be excited to buy the common stock outright at its current price today, then don't convert into it just because you're being forced by a call. Sell a convertible instead. Converting means making a fresh commitment of capital to the common stock, which you should only do if you've re-underwritten that investment case.
good point. We also need to remember that convertibles aren't pure equity plays. That bond component has its own risks, right? Like interest rate risk.
Definitely. People sometimes forget this. That bond piece has duration, just like any bond. That means its price will go down if interest rates rise, all else being equal.
So if rates shoot up, the floor value of your convertible could actually drop, eroding some of that protection you thought you had.
Exactly. Unless the stock is simultaneously doing extremely well, rising rates can hurt the convertible's price because the bond component loses value. If your entire investment case is just, I think the stock will go up, you might be seriously underestimating the risk from rising rates impacting the bond floor.
So the hierarchy for analysis really holds. You have to assess the credit quality first, then look at the maturity profile and the interest rate sensitivity, the duration, and only then really focus on valuing the option.
Right. And try to avoid layering risks, like pairing a really long maturity convertible with a company whose credit is already shaky, especially if you think rates might rise. That's asking for trouble.
Okay, final piece. Portfolio fit and sizing. Where do these instruments belong, and how much should you own?
Well, a high-quality convertible, one with good credit and decent terms, could play a few roles. It might act as a sort of cautious substitute for holding the common stock, directly giving you some equity exposure, but with a yield and that theoretical floor.
Okay, an equity surrogate. What else?
It could be a yield enhancer within your bond allocation if the credit is truly solid and the yield is acceptable. Or it could be more of a tactical special situation play, like when you identify one of those attractive switch trade opportunities we discussed.
And sizing. How much conviction should you have?
The key rule here is size the convertible position smaller than you would size a position in the underlying common stock. Because it has both equity risk and bond risk, credit and rate risk, you don't want a single shock, say a sudden jump in interest rates or a credit downgrade to hammer too large a percentage of your overall portfolio. Keep the positions manageable.
And monitoring them requires ongoing attention to multiple factors.
Yes, you need to keep your eye on at least 3 dials. 1, the company's credit health is stable, improving, deteriorating. 2, the equity thesis is the underlying story for the stock still playing out as you expected. And 3, the term structure, how much time is left until maturity, or more importantly, until the next possible call date.
And if one of those dials starts flashing red,
You need to react. Don't wait for all 3 to go bad. If the credit starts to wobble significantly or the equity story breaks, you need to reassess immediately, even if the other factors still look okay.
okay, let's try to wrap this up and consolidate the key lessons. The biggest danger seems to be behavioral getting too caught up in the stock story.
Definitely. Anchoring on that upside potential and kind of mentally minimizing the trade-offs, the lower coupon you accepted, the risk of getting called early, the dilution impact from warrants, it's easy to do.
So how do we fight that bias?
Force yourself to look at the bad news first. What's the realistic bond floor? What's the earn-back period for the premium? What's the call risk? Address those negatives head-on. And crucially, have that pre-written plan to systematically take some profits when things go well. Don't let greed take over. Don't move your goalpost just because the price went up. Stick to your process.
Okay, let's nail down some fast rules. 3 quick, non-negotiable rules for dealing with convertibles. Number 1.
Rule 1. If you wouldn't be willing to own the straight bond from that company at its estimated floor value, just walk away from the convertible. Don't do it.
Rule 2.
Rule 2. If you calculate that earn back period for the conversion premium, and it looks like the stock needs to make an unrealistically large move, or a move that will take longer than your likely holding period or before a potential call, then pass. The option is just too expensive.
And rule 3?
Rule 3. If the call protection is weak, especially if it's short, just assume the company will call it at the worst possible time for you. Plan for that forced decision, conversion, or sale, and size your position knowing your holding period might be cut short, or maybe just avoid securities with poor call terms altogether.
Got it. Now, 3 fast rules for warrants to make sure we're accounting for that dilution properly. Rule 1.
Rule 1 for warrants. If the number of warrants outstanding is significant compared to the number of common shares, you always have to adjust your valuation. Use that market value approach we talked about. Add the market value of the warrants to the equity market cap to get the true PI value.
Okay. Rule 2.
Rule 2. Pay attention to management behavior. If a company seems to use warrants again and again as a way to raise money, treat that as a recurring pattern. Expect future dilution and build that expectation into your valuation today. Don't assume this time is different.
And the 3rd rule for warrants.
Rule 3. Keep it simple. If you can't clearly map out the potential path from the current share count to a fully diluted share count and understand the implications on roughly half a page, the situation is probably too complex and opaque. Avoid securities where you can't easily model the dilution impact. Complexity often hides problems.
Excellent rules. To make this even more actionable for listeners, maybe we can frame those as a quick worksheet they can use. 5 questions to ask before buying a convertible.
Great idea. Question 1 for your worksheet. Would I actually buy the common stock today on its own merits, forgetting the convertible features for a moment?
Question 2. Based on the conversion ratio and the current premium, what percentage move does the stock need to make just for me to earn back that premium?
Question 3. What's my realistic, verifiable estimate of the bond floor value today? And would I genuinely be okay owning just the bond at that price if the stock part fails?
Question 4. When is the earliest the company could plausibly call this bond? And if they did call it then, what would my approximate return look like? This helps quantify the effective life of the option.
And question 5. The crucial decision point. Under what specific conditions would I choose to convert this into common stock versus just selling the convertible bond itself in the market? Write it down.
That discipline demanding clarity on what you own, the different ways you can win, and maybe more importantly, the ways you can lose that seems like the real edge when you're navigating these more complex parts of the capital structure.
Absolutely. It's about avoiding unforced errors.
Thanks for joining Capital Allocation Lab.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
Yeah, we'd love to hear from you too. Share your comments, maybe where you see convertibles fitting into a portfolio or what still confuses you about warrants, or suggest other fundamental topics you'd like us to tackle. Margin of safety, ROIC versus ROE, dividends versus buybacks. Let us know.
The goal here is to help everyone make better, more informed, long-term investment decisions.
Until next time, keep your process calm, keep your models simple, and keep your horizon long.
See you in the next lesson.